Good evening, everyone. Happy Independence Day. It gives me indeed a great pleasure. Sometimes words cannot describe how excited I am to have Shankar and Devina on this webinar. If I have to introduce them, I would like to introduce them as really the first power couple of Indian stock markets. Shankar, me and Devina, we've interacted for almost 20 years now, both in a professional capacity and also in a personal capacity. And one thing I've admired about their thought process is that they are original thinkers. They are able to connect trends, cycles beautifully. They are not afraid of being contra. They are not afraid of going wrong, which is very important. I distinctly remember when I started my career as a cub reporter in 2000, First Global was the first brokerage which called the market top in 2000. They followed a similar practice in 2007 when they called off the 2008 financial crisis. And they've also been accurate in calling the top in the telecom sector, the bottom in many stocks, and how they've been advocating their clients to always remember that markets always follow a cycle and the knowledge just goes beyond equities, stock markets. So today, we'll talk to both of them. Of course, we'll ask market questions, but we'll try and find out when a husband and wife have a disagreement, who finally has the final say in stock picks and also in real life. Now, Devina, I'm going to start with you. And no pun intended, I genuinely know you both from 20 years, so I was not pointing to your age or Shankar's age.
Sorry, I missed that, that last bit.
No, I said I know both of you from more than 20 years, so no pun intended. I was not hinting that all of us are getting old now.
Well, yeah. But as we were discussing last night, you can also look at it as a rebirth, because if you look at most of the people who have made a name in the markets, whether it is Warren Buffett or George Soros or Jim Simons, the real sharp trajectory happens after age 50. So, no problem if you are 50 plus, like we are.
Well, the data says that Buffett made 99% of its wealth after he turned 60. So at least I feel that a lot of us on this panel today will be excited to hear that number. But today's discussion is not about Warren Buffett. It's about you, Shankar, and Devina. Now, before I get into specifics, and Shankar and Devina, without getting into the postmortem of why markets have gone higher, let's look at where markets are headed from here. If I take the clock back and find why markets have gone higher, everybody has analyzed it and over-analyzed it. But what people are not ready to predict, understand, and explain that where do we go from here after this gangbuster or trailblazing comeback from March lows? Devina?
Okay, for one, of course, let us be also cognizant of the fact that while we've had a sharp rally, we are still down for the year if you look at the index. And of that index also, if let's say you take out Reliance, then the number looks even worse. So it is not as if that it has been a one-way bull market, which it has been for, the markets have gone up. But again, as we have said on other forums, this has been a more logical bull market than most. So we normally don't look at, index projections. In fact, we've never in our entire 25 years or so, we've never given index projections. So if we look at globally and in India, globally, the market has been very, very logical in terms of the sectors and stocks that have gone up. So if you look at a post-COVID scenario, it has been sectors and stocks which have actually benefited from this COVID lockdown. So it has been, obviously the obvious names are there in terms of the digital economy, which is like whether it is a Netflix or a Zoom, or if you look at the Chinese plays like Alibaba or JD and so on. But it has also been others like, there's been Clorox or a Domino's, because, people are sitting at home and ordering pizza. So there has been some logic to the move. In India, there was a stage where you had stocks which were not gaining, but which had actually been beaten down so much that you had a sharp rally, which was the rally you saw in June of financials, where you had beaten down stocks rallying, where as portfolio managers, we decided to sit out that part of the rally. But That other part of the rally which we have participated in has again been fairly logical. Pharma, again, that has also been a global bet. It has been a bet in India. Digital, as I said, various forms of e-commerce, digital, etc., which were a theme internationally. Here you had very limited stocks to play. I mean, more or less, you had only Reliance to play it through. So that has done well. There have been certain select other areas which have done well. So overall, it has been a fairly logical rally, barring, as I said, there was a rally in the beaten down financials, and the leverage plays we still don't believe in. So we have that entire whole segment we have sat out, and we continue not to touch that.
Shankar, you're the only one whom I perhaps know on the street differs from the common crowd, which is that markets and economy, they can remain dealing for a long period of time. First time when I remember you said you shared this idea 10-12 years ago, my jaw Shankar actually dropped. I said, Shankar क्या बोल रहा है भाई? Perfect बोलता है कि economy और market तो हमेशा link रहते हैं. But it's so true now. Earnings and markets are no longer linked.
Yeah, so I mean, the market, Nikunj, comes down to just the index constituents, right? And over time, we have seen that earlier there were banks and financials, and now you got Reliance, which I think is 12 or 15%. So where these blocks go is where the market will go, and they are really not going to be pure direct reflections of the underlying economy. I mean, to come back to the question you asked originally, which was where do we go from here? We are extremely optimistic, whether we take globally or we take India. I think we are headed much higher, barring obviously pullbacks and corrections, which are part and parcel of this thing. And this I'm not saying with the benefit of hindsight of the last 3 months or 4 months of rally. I am saying this, and I've been saying this to whoever cared to listen to me privately from the 4th week of March or the 1st week of April, that this wasn't a bear market in the context, in the sense of a 2000 or a 2008. Okay, this was a big sudden shock to the system, but not something that is not irreversible. Okay, in 2008, Nikunj, there were times when I used to sit and wonder, how will this world come out of this problem? It was really as if, I mean, if you have wholesale banking collapse globally, right? How do you come back from that kind of a, falling off the cliff kind of situation? Compared to that, this has been much sharper because the damage to people's livelihoods is obviously much more. But on the other hand, the business is still there, even though it might be a little lower, and it has now flowed to people who are survivors. And if you look at the market as only an index of survivors, I think the market looks very bullish. I mean, who can make the case that Pharma won't do well going forward, or who can make the case that a Reliance won't do well? Like I said, with the caveats of small pullbacks, etc., etc. But the fact is that you have a big global tailwind in all these sectors, and we are playing that even in India. I remain very optimistic on the market, at least on the stocks we own. Let's put it this way: on the stocks we don't own, we are not optimistic.
Okay, let me just add a little bit to this. The dichotomy between the economy and the stocks, because if you look at globally also, I mean, if you look at the US market, which has been around a long time, and over 20 years or so, the number of listed stocks is about more than halved in the US. That's number one. And now the top 200 companies make more profits than the aggregate of the listed universe. So that means all the balanced companies on the average make a loss. So that has been the skewness or the concentration on economic power, which has been a global phenomenon. And again, in India, you're seeing the same thing, that there are survivors and there are people who are the companies which are getting left behind totally. So that is why we say that it is not necessary that the stock market becomes a barometer of the economy per se.
So Shankar, will I be correct if I interpret that your view is that this is a logical bull market, but this is a market where the survivors are trading at a premium, whether it is Reliance in India, HDFC Bank relatively is done better, or FANG stocks or pharma stocks. This market is purely voting for survival of the fittest, a theory which we learned in biology from Darwin.
No, so let me correct you. In the US, for example, I mean, I sometimes I get surprised when in India when people start talking FANG stocks, the FANG stocks are not going to start, perform anymore. The reality is that the markets there have moved much beyond, the 4 5 stocks that dominated from 2017 up until 2020. Those have done okay, but there are other stocks who have gone up like, between, I think 3 and 20 times. So a stock like Overstock, which we bought in the month of April at around $10, is today $95. Okay, $95. That's not a FANG stock. So that phenomenon has changed. In India, Reliance, you can argue, is no longer supposed to be valued as an oil or as a petrochemical company, and I think there is merit to that because uh, the scale of transformation, and you have to hand it to Mr. Ambani that this is really transformational thinking. It's not just about the money; it's also about the thought. So you can no longer apply the old economy metrics to what Reliance should be valued at, because that will always be wrong till, I think we can be wrong for 3 or 4 years on valuation. And as you've known me, that, I'm not a big believer in valuation because you can justify any valuation. You can justify 100p, you can justify 5p. Okay, it all, that it's all a nonsensical number. So my view is, even though expensive, view things in context of interest rates. You've seen interest rates really collapse in India, relatively speaking. You've seen interest rates collapse globally near zero, 0.5%, 0.75%. When you view P ratios in the context of interest rates, you have to be prepared to pay higher multiples because P ratio is the exact on the other end of the seesaw as interest rates. The lower interest rates go, higher the P multiples go for same or similar level of earnings. I'm of the view that, the markets globally and in India are not richly valued. They are just about okay. And given the big tailwind of low interest rates, I don't see any end soon, to this current bull market that we are in.
Mm. Just to share with everybody here, we've got a full house already. 378 attendees or participants, and this is a webinar we'd like to involve everybody else, but these are just initial questions which I'm setting the tone here. In the second half, I'm promising you I'll try and get very individual with Shankar and Devina both to share the experiences about companies and stocks. Devina, now Shankar is making a very important point, which is that the bull market is back and the bull market is here to stay. So for an average investor, someone who is still getting a sense, oh my God, the train has left the station, the bus has left the stand. Do you think one should still take the risk, barring little bit of volatility? And can one expect double-digit returns in next 3 years?
Well, for one, I don't think anyone has got double-digit return in over 3 years. In fact, the interesting thing in India, of course, and going back has been that if you go back 5 years, equity fund returns on the average have not even beaten savings account returns. If you go back 10 years, they haven't beaten fixed deposit returns. So, we've been a long way away from compounding in double digits. So, as we've said that we cannot, and we are not making a case for the market as a whole. So this in particular is a market where you have to pick and choose. And that is, of course, looking at only at the stock market level. But the really big decision as an investor that people should look at is looking at the asset allocation. So that, you cannot look at equities, and that too Indian equities, as the single or only asset class you will be in. That, if people have to take away one lesson from this, that to my mind is the most important lesson. Equity is glamorous, it's interesting, it's fun to talk about, that you go to a party and say that I told you at the last party about this stock and it's up 50% or it's up 500%. But, on the average, all the time, if you are in equities, doesn't mean that you are going to make great returns, and especially on a risk-adjusted basis. If you look at 2019, for instance, that was a year in which you had gold going up 25%, you had government securities going up 15%, and equities went up only some 7-odd%. So, and this year again, if you look at, gold is up another 30%. Equity markets are still down for the year, still down about 8-9% for the year. So that is India only pie. So even within that, if you or your fund manager or your financial advisor had advised you to go out of equities last year, did they? I mean, that's the thing to think about, and that's India only. But really, if you look at asset allocation, and this is something again, coming back to what we talked about in the beginning, that some of the learnings sink in little late in life. This is something that is there on page 1 of every investment book, that almost all your returns will come from asset allocation and not from the security selection. Almost all means 85 to 90% at least. Whereas, everybody tries to find that one multi-bagger or, the 5 multi-baggers instead of focusing on the top-down level. So you have to have everything in your portfolio, not just Indian equities, but as I said, government debt, other debt, you have to consider at least, at every point you will not have everything, but all that has to be in your consideration set. Then gold, then other commodities. Then most important, you have to look at global markets also. Again, equity, debt, REITs, all of that. Of course, the flip side to that is that it is not easy to do that, because it is not good enough if the people think global means that you go out of India and you buy one NASDAQ ETF and you are done. You are still not really out of what we call SCARS, single country, single currency, single asset risk. So if you add one more country, that's marginally better than having only one country, but only marginally. And if you look at longer term, you will see that every year, really the leadership in which stock market does best in the world varies. One year it might be Denmark. Last year, for example, it was Russia, which was up almost 50%, 48%. Brazil was very high. Then this year, for the first half, both of these markets were down near the bottom, till at one point when the commodity cycle turned and they started to do better. So it's a very dynamic market. It actually has taken us 20 plus years to really get a grip of global markets, because we started doing it end of the 90s post the Asian crisis. So we know exactly how complex it is. And companies there also tend to be much more complex than companies in India. I mean, here it is still fairly simple, This is like the same old, steel and autos and IT services, all of which very modelable. But there it's a different matter. But having said that, as I said, that if you really want to have a proper risk return balance in your portfolio, you have to look at asset allocation and you have to look at global diversification.
Shankar, what you've learned as a firm in last 20 years, if I may encourage you to share in the next 2 minutes, which is that you've always said that there is always a bull market on somewhere in the world. The art is to identify it. You and Devina are sophisticated investors, you can do that. But for those who are on the webinar and those who want to perhaps understand that where the puck is going to move, where the next bull market is, not in India, but globally, how does one go about identifying it, and where do you think the puck is going to move?
So, the interesting thing is I can't give you a 2-minute answer. I mean, that is unfortunately the reality. It is a pretty complicated thing to figure out, because look, there's a lot of moving parts in this world. So there is currency movement, there is commodity movement, there are interest rate movement, there is sovereign debt, there are equity markets. All equity markets are correlated, but also not always correlated. So that's a huge, jigsaw, and it's all of us still sit and try and figure out things. We have done this longer, so we probably can do a little bit better job than most other, but it's not easy. So let's park that. The question, the answer to your question as to where the buck moves, that's really the crux here. And the interesting thing is, again, I go back to saying this, that when everybody in India started to talk about going and buying NASDAQ stocks, I said, ki abhi lagta hai ki NASDAQ ka time khatam ho gaya. Because, now when it has traveled all the way from the US down to a retail trader in India who's opening an account to trade NASDAQ stocks at, 2 a.m., that itself is a warning sign, because any trade which becomes so widespread that literally the shoeshine boy is telling you about it, you should become careful. So the interesting thing that has happened just in the last 3 or 4 months time is that the dollar has weakened. It's weakened dramatically. So it has fallen almost 10% against the euro, and it has fallen against the Taiwanese dollar. It's fallen against many, many currencies. So just when people said, hey, let's go and buy US markets, The moment it became the consensus trade, the dollar has cracked. So now you've got more returns being out of the US market and being in Europe and being in other market than being in the US market, which is what Devina was saying, that it is a damn complicated thing. Please, for God's sakes, don't think you can just do this by sitting on a computer and figuring out things for yourself. It is extreme. It's the same as doing, day trading in India, right? It's no different. So the answer to the question is, we think emerging markets are coming back. Okay. As opposed to just it being last 10 years being a pure US market driven market up move. We think that the tide is tilting a bit in favor of markets in our part of the world, for example. So just in the last 2-3 months, emerging markets have done reasonably well. The dollar has weakened, commodities have really rallied. That might be, again, no conclusions. We are always very flexible, we are always very harish, not bullish or bearish. Change. I'm just saying the view as of right now is that one should not be just thinking that equities equals US market, which is those simplified, lazy opinions break down very bad. You should not believe that equation will hold permanently just because it has held in the last few years. So market is turning. We have seen the turn in our global portfolios. Now we have the biggest allocation towards emerging market that we have had in several years, and not just today. We started it from April and May itself. So you need to be a little tactical here. Answer to your question is, Nikunj, I think India will benefit as a result of the tide coming out. At least not, I don't think you are going to the bear market, but the tide might recede a bit in favor of EMs. And emerging has been out of favor now for 10 years. We have seen that, right? From 2010 till up until now, emerging has been the worst place to be in. It's possible that the tide might be turning a bit in favor of countries in our part of the world.
So, Shankar, is the market, and again, I'm just quoting some of our previous interactions here between you and Devina so that our viewers and attendees can relate to it. Shankar always has endorsed that there is nothing permanent in the market. He always is a big votary of cycles, and he believes that cycles are based on historical trends. Shankar, is the market then what you foresee and what you have just described? Is it like 2003, 2004, where we saw inflation trade, commodity trade, everything made a comeback?
I think we will see. It points to some degree of revival in emerging versus global equity situation. I don't want to go out on a limb and say that this is the 2003-4 kind of a big thing, because there the dollar really cracked. It cracked hugely back then. Okay, it has fallen. The dollar has fallen, but not to the same extent, not to the same ferocity. So it might be that premature, but like we have got steel stocks in India. We bought in our domestic funds. We bought oil in our global funds in the month of March. In fact, last night we were sitting with Madhu, who had come on over home, and and we were reminiscing about March when he told me what is the best trade right now. I think it was third week of March. I said go and buy oil. It was $16. Okay, so we bought oil back in March. We got silver. Gold we have held for a long time. So there is a general, again, don't have too many strong views. I think the tide has shifted a bit. The needle has moved a bit. The needle which was stuck only US has moved a little bit away from a only US trade. You see?
Yeah. Devina, I distinctly remember when we've discussed markets in the past, Shankar and you have made a case for select buying in Indian small cap stocks. Considering that the tide is shifting, there is a COVID crisis, Devina, what happens to the small cap space in India? Because some of them may not survive, some of them may not revive, and very few actually will now flourish in this kind of an environment, Devina.
Actually, see, small caps is usually in that framework that where you cannot buy everything, because small caps is tough, much tougher than large caps in general, because that is not a homogeneous kind of basket. As you said, some of them may not survive, some of them might flourish. So you have to be very picky when looking at small cap. And you had this small cap rally which was making up for this large long period of underperformance. So you have to again pick and choose within that, whether you have to look at again maybe pharma, maybe chemicals, maybe some other commodities, maybe there is a shift in certain commodities where either imports from China would be affected or exports from China to other countries will be impacted, where certain companies here might have an advantage. But small cap always has to be a stock by stock, and mostly stock by stock, even more than industry by industries. Large caps you can still play sector wise, small caps you still have to drill down and see, because the possible issues on governance and a lot of other things can also be there. So be careful, but there will always be pockets which will make money, and we always have a diversified basket of stocks where we invest in across market caps given certain liquidity parameters. So we don't believe in very concentrated bets. So it's never 10, 15, 20 stocks in our portfolio. It's always 40 plus or so, because that's what we have found, both mathematically and in real life, because that gives you both higher returns and lower volatility. So this is like really the holy grail of investing, in the sense that you get the balance of both.
And that's a question which has come from Saket Kapoor, I think, which you've addressed, that what is the way forward for small and mid-cap stocks? I'll start incorporating some questions from the webinar just to encourage participation here. So please keep on sending your questions.
I will,
Yes,
Nikunj,
Shankar.
I will add to Devina's point, and the point is that you cannot look at small caps in isolation. Small caps must be there in your portfolio, but they should occupy 20% of your portfolio. And if the cycle is very favorable, maybe 30-40%. But if you put 100% in a small cap basket, you are going to make out very well for a year or two, and you might flame out completely. So they occupy a place, but not the entire space in your portfolio. Just bear that in mind. There are very good companies, but they should be 20-30% tops of your portfolio.
Shankar, you've been raising concerns on various forums that banking stocks were becoming obese. They became obese, and before they cracked, they actually reached Humpty Dumpty levels. They had financials had a weightage of nearly 35-38% put together in the Nifty. Do you think the multi-year bull run in financials as a category is over for many years to come now?
Well, the data is speaking loud and clear, right? Two things, right? Most stocks have, made all-time highs in India, but the banks are nowhere close to making that. NBFCs, I don't know when they will even get close to the all-time highs, right? The data is very, very clear. So, I mean, sometimes the market tells you things that you don't want to hear, but it's telling you something very, very clearly. It's a troubled spot. In February, it was very clear it was going to go into strife. When there is economic trouble, it's commonsensical that banks will bear the brunt of any economic debit, right? I mean, we all know that. And yet, I don't know why people are having 45, 40%, even 60% of their funds in financials. Now, what has happened since? All the guys who are in any capacity or capability to raise money have been raising money, right? All of them. You take the marquee names and the less than marquee names, all of them raising $1 billion, 2 billion, 1.5 billion, maybe more. That is the nature of this business. It's a pathetic quality business. At the heart of it, banking is an abysmal quality business. It just thrives on raising vast amounts of capital, and the capital needed for two things. One is to fund growth, because in order to grow assets every year, you need more capital, because then you can lever that up and grow. Without additional capital, you cannot grow. Number one. Number two, you need capital to fund your losses. As we are seeing right now, nobody is raising capital for growth, by the way. Right now, everybody is raising capital to fill the bloody hole which has been created, which has been papered over with this something called moratorium. This paper will get torn away a few months down the road. So before the market gets to know the size of this crater, let's go on the road shows, at least the Zoom road shows, get money in. That is how pathetic this business is. मतलब really हिंदी में बोलो तो इससे थर्ड क्लास बिजनेस मैंने लाइफ में नहीं देखा कि बॉस you make a way for thin margin and You amplify that by vast amounts of leverage to deliver a 12-14% return on equity. So what kind of business is this, right? So even at the best of times, you should not be buying it. And HDFC Bank will come once in a lifetime, but that's the exception that proves the rule, right? That how many such banks have been created in the last 30 years of opening up banks in the private sector. We forget the names of the 90s. You know, there was a Times Bank, there was a this bank, that bank. They all came and went. We just look at the survivors and say, hey, but HDFC Bank, right? I said, how many people died around HDFC Bank?
Great point. So Shankar, since you mentioned that Madhu was at your house, your Twitter handle captures a picture. What you told us that what you told Madhu to buy in the month of March. What you did not tell us is that what you told Madhu last night when he asked you what to buy.
No, last night it was a monkey. So we were enjoying his API trade. I mean, I think nobody understands pharma the way Madhu does. I mean, I have nothing but admiration for his pharma understanding and picks, and they have been a rocket. We own, unfortunately, not all of them, but we own quite a few of them in our portfolios, and which is one of the reasons we are up for the year. 20% plus for the year because of some of the things that Madhu has liked, and we own them. So it was really pharma has proven to be an absolute rocket in this whole period. I mean, there has been and pharma and chemicals, both sectors, again, we've had like nearly 60% in these sectors, 25, yeah, around 50-60%. They've paid us very rich dividends. So really, Madhu was talking more or less of this.
Devina, do you see this entire bull run to continue in pharma and specialty chemicals? Because that now is the pretty girl in the town. If a company has a prefix chemicals or a suffix pharma, those stocks have got re-rated. Why are these stocks going higher? Purely because of ownership pattern change, or this is a true blue bull market? Devina.
See, there's some fundamental reasons why they're going up. Like as I said, that part of the reason is both import substitution of what was coming in from China, plus what China was exporting to other countries. Theoretically, at least some of that is available to India if the companies can gear up. But chemicals, for example, is a very, very broad term. So you have to really see what that particular company is doing and whether they are benefiting. So you cannot, just say that anything which has a chemical suffix will do well. But as broad categories, as Shankar just said, that right now, and for some time we've had significant weightages in our portfolio. We continue to hold them. But, if for anything that we hold in our portfolio, whatever is the reasoning, in a sense, whatever is the story, is never something we are wedded to. I mean, that is something that we consciously avoid, that do not storyfy, do not say that I know what this company will do 5 years hence and 10 years hence. Yes, you have a hypothesis, you have some reasoning, but you are also watching it like a hawk to see both on the fundamental side as well as the price side, what is happening. And if facts do not bear out your story, you are out of it. That has to be the discipline you have. So there might be, as I said, there, as want of a better word, stories why you like something, but doesn't mean you will like them forever. So that caveat should always be kept in mind. As I have said many, many times on Twitter, also don't ever fall in love with your stories or with your stocks. That you should leave for family and friends. Stocks or securities or other assets have one purpose and one purpose only, which is to multiply your wealth. If they are not doing it well, please get out of it.
Great point.
So, I'd like to add, to that, Nikunj, with your permission.
Yes, please. I mean, if Devina is asking something, we have to show chivalry. Shankar, she criticizes us enough that Indian men are not chivalrous.
So
as I told you, Nikunj, I've been doing it since I was 12. It's slightly late to get out of it.
So if you see even this rally, okay, from the first of April, more or less, one of the major areas of the market that has lagged the market have been the FMCGs, right? You see, so an Asian Paints has lagged the market, a Lever has lagged the market, a Page Industries has lagged the market, a Relaxo has lagged the market. They have not been what they were in 2019. You see, again, the market has thrown a surprise. You see, the market is an ever change. It's like literally, it is such a beautiful organism. It will change in front of your eyes even before you realize it. And when the consensus trade became that buy things that produce things that of daily use. So produces a shampoo, a chocolate, or a chappal, or an underwear, or whatever. Those stocks will never go out of fashion, right? That we have been told that, we have heard that, moats and Buffettesque and all that kind of stuff. Now the trade is changing in front of our eyes when all these companies, okay, have lagged the market significantly in the last 4-5 months time. And that is again one of the things that what Devina was saying, that we became so wedded in our minds that we can't go wrong buying a lever. We can't go wrong buying an Asian Paints. Guess what? We can go wrong. And we have gone wrong in the last 5 months, buying Asian Paint, buying lever, buying a Relaxo, buying a Page Industries. You see? And one more thing, again, very important. Whole complexion of the retail industry in India is changing. We all know that, right? So it's becoming more organized, and by the way, with this whole COVID thing, a whole scale collapse of the small store has happened, right? Small grocer, small kirana, small supplier. Who is going to take that over? Now you'll have the giants taking over these, or at least getting them organized. So geo platforms will organize kirana stores into a larger mass, or maybe a DMart does it, or maybe all of them do their little bit here and there. What is the effect of that on FMCG companies? What is the effect of organized retail on FMCG company margins? It's obvious. It's obvious. It does not take mathematical genius to figure it out that these companies enjoyed a negative working capital, and because their buyers, who were the small grocers, were obviously not organized. They were not one block buyers, correct? They were scattered. Second, they could get higher margins because the buyer is not organized. Moment that changes to an organized retail, the bargaining power of the organized buyer will increase versus that of the seller, which is your Levers and your Nestlés and your Britannias and everybody. It has happened globally. I can tell you that much. It will happen in India. What happens to the valuations of 60 times, 70 times, 80 times that we have been paying for these companies, where you can see that retail is getting organized in the hands of a few majors, and everybody says, हर retailer क्या बोलता है, मैं 10% सस्ता दूंगा दूसरे से, यही कहता है ना, what's the promise? तो कौन सा अपने जेब से थोड़े देने वाला है वो? अरे जाके लीवर से ही लेके देगा ना, ब्रिटानिया से ही लेके देगा ना, रिलैक्सो से ही लेके देगा ना, वो थोड़े लॉस बना के आपको देने वाला है. It's when you put things together, you probably then start to see what the market is saying by underperforming these stocks. I'm not saying market has figured it out, but at least we are sitting and worrying about this right now as we speak.
In fact, Nikunj, interestingly, we had done this exercise of whole 20 years ago, 20 years ago, we had said, let's compare what it used to be HLL at that time. How is that doing versus Unilever? How is P&G India doing versus P&G, etc.? And our big finding was that the big advantage that the Indian FMCG companies had was this negative working capital. Whereas there, the Procter & Gamble was selling to a Walmart, which was equally as big and has had more bargaining power, and therefore they had to give credit to a Walmart. Whereas in India, all the FMCG companies, and especially Levers, was actually just living off what they were getting from the trade in advance. And we had at that time itself hypothesized that at any time that retail gets organized in India, you will see similar pressures. And now, almost 20 years later, you're seeing that happen. And another interesting thing is also what Shankar was saying, that, like last 5 months, these companies have underperformed. But also, in all our minds, there are many, many human biases, and there are very interesting books you can read on biases. There's like Thinking Fast and Slow by Daniel Kahneman. There is The Invisible Gorilla. And one of them is a recency bias, that whatever happens recently, we think it has been happening forever. So we actually also did an exercise of how these consumer companies have done, not just in the last 5 months, but over 20 years. And you find that, there are long patches of time, like 5 years, 10 years, 15 years, even where their returns have been abysmal. You look at Lever, they're like whole 90s. It was, for 5-7 years, it compounded at 2%. Then another almost 10 years, it compounded at 7%. Colgate had negative returns for 7-8 years. And, Bata did nothing for almost 15 years. It, 0% return. So this whole thing of that these have always traded at a huge premium, that these have always given great returns, did not even hold prior to this crisis. So we just, extrapolate what has been happening in the recent past, and in our minds think that this has always happened. So always very important to look at data, because otherwise your mind will play tricks. I mean, you go back to Charles Darwin, he actually used to keep a notebook to write down all the things that were against his hypothesis. But he said, otherwise, as a human being, we tend to just disregard anything which is against our hypothesis. So look at data always and don't take, lazy opinions. The same with NASDAQ, that because it has been doing very well in the last 1.5, 2 years, we think that's always a safe haven and the best place in the world to invest. Always look at data. That would be my advice to all the viewers seeing this.
Such a great point, that recency bias and the fact that Devina talked about HUL, but the classic example here is ITC, which frankly has done precious little in last
It's
couple of
now
years.
been quietly forgotten that it was ever in this consumer list, along with Gillette, along with Colgate.
ITC tha. Hai is not the word which we use for ITC now. Lever hai par rahega kya is what I think Devina and Shankar are trying to bring about in terms of the portfolio allocation. Shankar, I have to ask you on Reliance. There are so many questions which are coming on Reliance. Everybody really wants to know. And there's a bull case here, Shankar, and a bear case here. Bull case here is how Reliance has reinvented themselves. The bear case here is that Reliance is now 14-15% of the Nifty. And typically when that happens, the stock tends to peak out or tends to enter into a time-wise correction. So where is Reliance headed now that it is nearing a $200 billion market cap, Shankar?
So yeah, I mean, I agree. I mean, I think incremental gains from Reliance, I think, will be muted. It cannot become a $500 billion company without, in my view, without a listing on the NASDAQ or on the NYSE of the GE platforms. It's only then that you will, if assume for a minute that the Geo platform listing happens at $200 billion or maybe 300. I mean, I'm not making a prediction. I'm saying assuming. Then you might see a big push up in Reliance, but I'm not even clear when they intend to do that. I don't think anybody is clear yet. So therefore, $200 billion is a lot for a market of India's size. I think there will be, naturally, a pressure on the stock in terms of, I don't think it falls much, but I don't think it's going to give you what it has given us from the month of April, for sure. I mean, so we bought 1400. We are sitting on a 50-70% gain on that. I think for now it is done.
Somebody sent me a very nice WhatsApp forward, Shankar, really in the Bollywood style, that Indian stock market has one Karan and Arjun, SBI and ITC. उनका समय कब आएगा?
हमारे पास दोनों ही नहीं है. क्योंकि it is not Karan, मतलब Karan Arjun कौन आएगा is one, मेरे दोनों बेटे आने वाले, that is one, and the other was in खुदा गवाह. Sri Devi goes mad because Badshah Khan, Amitabh Bachchan has gone to India to settle some score or something, and then she keeps saying, "Ek din Badshah Khan zarur aayega." And obviously, that he takes a long time to come back. I don't think ITC and SBI, at least in the foreseeable future, look to be becoming huge outperformers. ITC, I know, has done a great amount of work on, again, reinventing itself as an FMCG company. Okay, for sure. I mean, not to take away anything of that sort. I don't think, again, FMCG itself as a business will be what it used to be for the reasons I just mentioned. And ITC won't be immune to those either. So therefore, there are easier places to make money. And remember one thing, again, Nikunj, I mean, I don't waste time trying to figure out things that will become relevant 12 months from now. I buy things which are relevant today. So I have no desire to be so early in the trade that, I buy and then I start to say, Karan Arjun kab aayenge. जब अर्जुन आ जाएंगे, करण आ जाएंगे, तो हम उनके घोड़े पे चढ़ जाएंगे. बहुत बात खत्म हो गया.
Devina, lots of questions are perhaps coming on asset allocation. I'm trying to open it for the webinar and for some questions which we're getting from our attendees now. And I can see there is a lot of young audience, a lot of young people who look up to you both to understand from your experiences. How should somebody start with the very basic planning of asset allocation, Devina? Because in India, the problem is either we do FD or we do FNO. So there is nothing in between.
Yeah, I mean, right now all the new entrants are in the latter category. I think worldwide, people are using the lockdown to think that they can trade and make a living out of that. Actually, asset allocation, as we've spoken, is like there's no easy answer simply because it has to be tactical. Of course, this year is not a typical example, but if I look at this year, in February, we had less than 10% equity. We were almost entirely in gold, and if I look at globally in treasuries and in investment grade bonds, which was very good because when the markets tanked 30 to 40% around the world, we were down only 5-7%. And then by March end, we just started going back heavily into equities till, we're now 80% equities. So, I mean, the answer, as I said to that, is that they're not very easy answers. So, because this is a dynamic world, and within each category, there are very many nuances. I mean, for example, I will give you a recent example. We just published a blog on that, normally, let's say in fixed income in the US, you look at this binary of investment grade and non-investment grade, or the high yield as they call it. And you say that, you either buy this or that. But we actually, when we exploded the high yield part, we found that the best place to be is the highest rated within the non-investment grade, the double Bs. That is actually on a risk-adjusted basis, both better than investment grade and better than the lower high yield bonds, lower rated high yield bonds. So, it's not very easy to do it on a do-it-yourself basis, but on a do-it-yourself basis, at least look at everything. And when in doubt, be a little more on the low risk side too, because, this is also very important. This is again an important message I want to give to your entire audience, that the first mantra of any investment is risk management. So avoid the big loss. Wherever you are investing, first think of the worst case, and also think of whether you can live through that worst case. Let's say, for example, Shankar was saying that many funds were 40-50% into financials at the beginning of the year, which means, that when the markets fell, they were down 35-40%. I mean, they meaning their investors were down. So once you are like your 100 rupees becomes like 65 rupees, you have to be up 50% before you are even at break even, which is like normally a 2-3 years journey. So, whatever you do, first mantra is risk management. For example, we invest through what we call a human plus machine model. But while on the investing side, we do have some human overlay, on the risk management side, we have no human overlay. So if the system say get out, we are out emotionlessly.
Let me add to that. Yeah, Devina, just a quick one on that. Nikunj, the whole business of investing should be only about getting knowledge or advice from whoever your advisor is. He or she should know all the aspects of asset allocation, meaning they should understand gold as well as they understand equities. They should understand fixed income as well as they understand commodities. If you understand only one and not the rest of the pieces, you are not going to be able to win at this game. It's like saying in cricket that कि यार मैं सिर्फ cover drive खेलना जानता हूँ, लेकिन ना मैं on drive खेलूंगा, ना मैं cut खेलूंगा, ना मैं flick खेलूंगा. So you have to learn all aspects and how they connect with each other. That is how you learn asset allocation. There is no easy mantra to it, which we can talk about in 2 minutes time. I mean, that's really the important point what Devina is mentioning.
But Shankar, just for a non-sophisticated investor, somebody who is really looking at making a good asset allocation, do you think by and large ETFs, a combination of gold and Nifty and perhaps one or two mid-cap stocks, can they really fulfill the basic needs?
Not at all. Not at all. Not at all. Absolutely not. That will not do the job. Buying two stocks is one of the worst things you can do. If you have to indeed go out and buy stocks, buy at least 25 stocks, not two stocks and five stocks and 10 stocks. By natural selection, assuming you've done a reasonable homework, you should be able to find one or two good stocks in your 25 stock list. Okay, if you are very, very good, you might find five. But if you buy only five, you may not find even one. Okay, so therefore, in the stock part, have at least 25, not less than that. Also put some room for gold. It's a natural hedge. We all know that, over time the rupee keeps depreciating, barring some moderate periods of appreciation. Indians have been smart for decades and centuries. They hoarded gold, and that probably delivered much better risk returns on a risk adjusted basis than even equities have. Have some fixed income. Equities, by and large, for most people, unless you're really professional grade investor, should not be more than 30-40% of your overall asset pie chart. Okay, it is unwise to be 70% in equities. It is really unwise unless you are extremely proficient at this game. That means you are really a pro, and you will become a pro only when you turn 50. I can guarantee you that.
Devina,
It's a necessary but not sufficient condition. So you have to actually do a lot of homework and then turn 50. Then it works.
okay. Now, I don't have the picture of HDFC Bank on which the first Global initiated a buy. It's there on the Twitter handle, which is that a baby who will become Arnold Schwarzenegger. Now, Shankar, while the babies become Arnold Schwarzenegger, a lot of Arnold Schwarzeneggers have also got wiped out in last 25 years.
They become babies.
Yeah. So if you have to, let's say, publish the same report that agla Arnold or agla baby kaun banega, how would you publish that report?
No, so in banking, I think there are, we know Yes Bank became Arnold Schwarzenegger, and now what it has become. You can call that a baby or a delinquent child or whatever you want to call it, for all kinds of wrong reasons, wrong management. But and I hope and I pray it comes out of it, because it is an important bank. But that would have been the closest to being from Arnie to a baby. Other than that, in terms of, if you're talking small cap stocks per se, there are quite a few stocks which are on their way. I mean, in small cap, the difference between HDFC Bank and the rest was really the management quality. In most small caps, you're never sure. Okay, let's be very clear about it. बंदा कुछ बोलेगा जो उसका कल कुछ दिमाग और हो जाएगा. Most small cap managers will have one chartered accountant as an advisor, and whenever there is a chartered accountant as an advisor, I become very, very wary. So that's usually a decent red flag. So you don't know how these guys will handle success. How will they? Because handling failure is easy. Okay, most of us can handle it. Handling success is extremely difficult. And when they go through a good patch, then raise capital, investment bankers will call them. Arey sir, utha lo paisa, 500 rupees ka भाव था, 20 rupees था आपका 2 साल पहले. Then they raise capital. They'll keep diluting. So all those things you've seen too many times. It takes a very smart management to say, I will not raise money. So by the way, the only company we own in financials is a gold loan company, which has not raised capital for the last 20 years, which is a rarity in the business of NBFC or banking, per se. And so therefore, finding a baby who becomes an Arnold Schwarzenegger is basically a management thing. And that will take time. And now in HDFC Bank's case, we knew Aditya Puri, we knew his whole team, we knew Paresh Sukhankar, we knew Shailendra Bhandari. They were all there with us in City. So we had in some senses an unfair advantage in knowing that these guys know what this game is. And with the HDFC parentage, you knew it was going to become a pretty decent bet. But to make that for an average company is very, very hard.
Okay, we are in the last leg of this webinar. We've extended. I'll take the liberty of using my goodwill and relationship with Devina and Shankar for extending this for another 10-15 minutes. I mean, I'm shamelessly troubling them, or we are shamelessly troubling them on Independence Day, literally. So Devina, let's talk about how the markets have changed, from paper trading to demat, from algorithm trading to the kind of global, fast trading, machine-based trading. Do you think the shape of the market, the speed of the market, the velocity of the fall, the rise in the comeback, everything will get very, very small? We are no longer in a period of multi-year bull market or multi-year bear markets.
That necessarily is not the conclusion, but you are right, especially in the US, when we see how these algo trading and all these other things, what they do is that at a point in time in a day, like for example, if a company misses earnings, you can see a very, very big fall, which may or may not last beyond that one day, but all these things accelerate that. But if you look at it as an investor, because we are not talking of day trading, if you're looking at it as an investor, I'll tell you what the changes have been. One, if you go back, I started in equity research when the term did not exist. When no company knew what equity research was, I used to call up companies and they would say, what is this? So from there to now, one big difference is that all these years, both in India as well as globally, you had investors, essentially fund managers, having privileged access to information. So companies could give certain information to certain people and not share it with the public at large. You could have a closed door meeting and give, and this was not just in India, this was in the US also. Now what has changed over the last 10, 15 years has been regulatory, both in US, in Europe, in India. So that privileged access to information is no longer there. So that one thing has changed. The other thing is that now, in fact, a lot of information is available, a lot of data is available. But if you are going to process it as a human being or as a small team of human beings, there is no way you can process that entire data. So now what we have found is that if you want to have an edge, you have to have methods to tackle that large data, that large amount of data, and make proper objective sense out of it, rather than looking at lazy opinions, that because that's what the human mind does, that you can't cope with that much data, so you make an easy cause effect and this is how it's going to turn out kind of story. So that to our mind was what drove us also in what I was talking about, a human come machine system rather than a human only system. And as I said, I came from a very, very human only system. I did it for many, many years, actually, going around the country and going around factories and going around offices, meeting everybody I could. But now the game has changed, and not just on the trading side, which was your original question.
Shankar, a lot of questions. I'll pick up some webinar questions before we start wrapping. What is one asset class one should avoid for next 12 months to next 18 months?
So you should not avoid anything. That's the beauty of allocation, that you always have your foot in the door. Think about it as two guardrails. Okay, when you're driving on a highway, you're going at high speed. There are guardrails kept on two sides. That you cannot go beyond these guardrails. Asset allocation are the guardrails to your portfolio. Something and everything, because you never know where a bull market will suddenly ignite. It's only the percentages that you can decide tactically that I want X in Y in this one and Y in another one, and how you do that is another discussion, a very long and complicated one. But do not have zero in anything, in any asset. Okay, people had zero in gold till 2003. I mean, they had gold in their homes and all that, but not as a traded commodity. Okay, from the 1980 till 2003, gold did nothing. Okay, gold did nothing. From 2003, from $250, it went to $1,200, $1,400 matter of 4 years time. So that is how these things, when they suddenly wake up and go up 4 or 5 times, you don't know. Silver was a forgotten commodity, and we've seen what silver has done in the last 2 months time, right? Gold was given up for dead. Oil has gone from $5, $10 to $45 in no time. So have something in everything. Let the market tell you where you need to get yourself positioned. It will tell you for sure.
A very common question, Shankar, in the thread of questions today is that what private banks have done in terms of wealth creation can the Indian insurance sector do in the next 10 years?
Potentially they can, for sure. Again, the insurance market is, in my view, in terms of quality, it is a far better business than private sector, banking, than banking itself. And the only problem is, I can tell you what the problem is, that all the insurance companies had already remained unlisted for a very long period of time before they came to the market. So in large part, the value had already been captured prior to their becoming listed entities. Unlike an HDFC bank, which listed within 1.5 years of actually having started business. That is a very big difference. So it listed at I think it listed at 30 rupees or something, which is 3 rupees on an adjusted basis. I think a 10 rupee share traded at 3 rupees. So it was a par issue. Okay. And and you got the chance to ride it out completely for the next 20-25 years. Insurance companies have not come to market right at that infancy stage. So it will create wealth, but not to the extent what an HDFC bank did.
Devina, in today's time when gold historically, which is considered to be a hedge and safety, do you think it will lose its charm and Bitcoin could be a trade for next decade?
See, Bitcoin is not something that I have studied in detail, so I would not like to make a comment on Bitcoin per se. On gold, of course, as Shankar has said, that it's done well for the last some time. Have been, if you look at the long-term history, there have been whole decades when it has not done nothing and in fact gone down. So it's not again something you can say that I can buy and forget for 10 years unless you want to wear the jewelry. That's a different matter altogether.
Fair point. Shankar, questions I think are coming and you can make out that these are people who've just started investing or they want to understand how should one start? What are the books to read? And if I could just put in a little bit of ET Now advertising, apart from watching ET Now regularly, what else should a first-time investor do to learn markets?
So first and foremost, you must learn all the basic, math and arithmetic of markets. So reading a balance sheet, what do you mean by cash flow? What do you mean by cash flow yield? Getting the basics right. And then start off your journey by reading all the, the great people in this world. Although I don't believe there are any great investors. I'm very clear that there are no great investors. There are only great traders. So we have seen Warren Buffett has gone and bought gold after mocking it for almost all his life. He's now gone and bought a gold miner. So I mean, and I think that is quite a, it's a late trade. So the fact of the matter is, investing, you need the basics and then go and start reading. It's an endless journey. Both Devina and I still continue to read. I cannot tell you one book. I can tell you, 1,000 books. And also, do not just focus on investing wisdom. Investing is a wide subject. So if you have learned something in history also, in geography also, in physics also, it will come to help you right throughout, your investing journey. But in large part, if you're young, if you're young and watching this, learn to always be skeptical of what you hear. Learn to be a skeptic. Great investors are almost always skeptical of what they hear. That's how answers are born. कि यार ये कैसा ऐसा क्यों है? ये ऐसा क्यों होना चाहिए? Just because somebody has said this for 10 years, is that supposed to be accepted as the gospel? Great investor or great thinkers will always question. You must have questions. Only then you will get the answers. Don't see a newspaper or ET Now channel and accept blindly everything that is being talked about by either me or Nikunj Dalmia or Devina Mehra or Rakesh Junjunwala or Ramesh Damani or Warren Buffett or George Soros. Do not accept anybody. Test it for yourself. Apply the test of knowledge, logic, reason to every opinion you hear. Please do that, including my opinion.
Okay, last question, Devina. No trick questions here, but if there is one thing you would like to change about Shankar, not the husband, but investor, what would you like to change, Devina?
I think it has been a journey. So most of it has, the changes have happened, as I said, from where we started, both in terms of going global, or as I said, from moving through a human-only model to a human-come-machine model. Because, in fact, just to give you an idea, we had a portfolio management license for 20 years, but till we were certain that we had a model that could deliver something consistently, we did not actually launch a service, because it's only when we tried this human come machine model, saw it work, that we said, yes, now we have something that is replicable, which is very different from the way you might be doing prop investing, for instance. So that journey has been there for both of us over a period of time.
Now you're speaking like a good wife, Devina. Nothing you want to change about Shankar?
You said on the business side. On the other, it's just rather long.
That is true of all wives. You know.
I will hit the pause button here, Shankar, before we get into what you would like to change about your wife, but we will not get into that.
You should not.
Okay. 3 questions on the same topic, Shankar, just because people who are attending this, they want to understand that if they want to approach First Global PMS, is there a ticket size and how can they open an account there?
It's very straightforward. On the India side, SEBI regulates PMS products, and they say 50 lakhs is the bare minimum that you can start off. It used to be 25. They raised it in just this year itself to 50 lakh rupees. That's on the India PMS side. On the global PMS side, we start only at 7.5 lakh rupees, $10,000, and we have a global fund which is $100,000. So depending on what size you are, you can start with 7.5 lakh rupees, or 75 lakh rupees, or 50 lakh rupees for India. So it's pretty straightforward. We basically cater to the entire spectrum, really speaking.
And all the information is available on your websites.
It's all on the website, or you can throw us an email on info@firstglobaltech.com. We get back very quickly, always.
Okay. तो अब शंकर अब बात करते हैं last question.
We've
spoken stocks, we've spoken asset class. अब खाने की बात करते हैं. Haven't seen a tweet from you on food, restaurants.
I want to support them, Nikunj. I mean, it is a very, very saddening thing to see the kind of state, our hospitality industry has gone into, and we feel for it. I mean, all of us have to feel for it, because it is, the hospitality industry is such a big employment generator, So and आप restaurants से खाना खा के निकलते, जैसे कल मैं और मधु बात कर रहे थे, निकलेंगे तो पान वाले पे जाएंगे, पान वाले के 5 लड़के होते हैं, वो पान बना के आपको देते हैं. I mean, what has happened to all these small trades? So it's a really worrisome thing. So we are ordering in, but it's not the same thing as going out, because the waiters are there, the valet is there, the pan dukan wala is there. Yeah, I think it's a sad thing. But Madhu brought some good food last night, so we had a pretty decent meal.
You said Madhu at least 10 times in last 1 hour.
It was an inspiring meeting, I can tell you. I can't reveal some of the plans that he told us about, but I'm sure he will get talking to you, or you will talk to him just after this. But it was just a fun thing to hear his journey and everything. It was just great fun.
We had him in the same forum a couple of weeks ago, and what an extraordinary journey he's been. Devina, I have to ask you this as the last wrap-up question. Promise, last one. What's been this COVID? What's been the most joyful and the most tense moment for you, Devina, in this entire COVID period, as an individual, as an investor, as a wife, as a mother?
See, for us, actually, the change was not that drastic, in the sense that we do largely work from home, both of us. So it was not such a big change. And we have also been used to being together 24 hours for a long time. So those things at least did not create an issue for us. And of course, we were stuck away from home for 3 months in Delhi, because we happened to be in Delhi when the lockdown happened. But given all the suffering all around, I thought, our little travails were of no consequence, So it was not really something that you could feel bad about when you looked at the migrant workers on the road and people losing jobs and businesses closing down. So that was the hard part, not what was happening to you, which was fine. You were stuck away from home for 3 months and then you eventually managed to come home. So that is really, and still it's not as if the problems are behind us. Still a lot of suffering all around.
Well, these are challenging times, where we were versus where we are. I guess we have a long way to go. But Shankar, Devina, Thank you to both of you. Last 1 hour, actually not 1 hour, more than 1 hour. We just covered a lot of topics. And by the way, before I wrap, there is a request coming for Shankar to sing. And Shankar, let's make that as a grand finale. I will keep it open. You choose the song, but let's wrap up today's webinar with a song which you like.
Yaar, Kamal, you should have warned me before.
Markets never warns you before it corrects. So it's like this.
That is true. So this is my correction.
So this way I will also get to hear it, because now, this was all at courtship time. Thereafter, like all nakras. So I have to wait for the public singing.
Okay, Darshan, Shankar, let's take the clock back. 25, 30 years ago, before we sang for Devina, which song was that? Let's sing that and then we'll wrap.
एक लाइन गाऊंगा, ठीक है? आपके हसीन रुख पे आज नया नूर है, मेरा दिल मचल गया तो मेरा क्या कसूर है, आपके निगाह ने कहा तो कुछ जरूर है, मेरा दिल मचल गया तो मेरा क्या कसूर है.
Well, that was fascinating. That was lovely. So, Devina, I've made the impossible happen today. Took you back 30 years. But thank you both very much, and stay safe.
Thanks, Nikunj, for having us.
Going forward. Thank you very much.
Thank you, Nikunj. You have a good weekend. Thank you.
Bye bye.